All right, how's it going, everyone? Hope you're all doing good. Um, Today, I want to talk about the Commitment of Traders Report, the COT report. Now, this is Investopedia, and here's what it says. The definition of the Commitment of Traders Report, a report published every Friday by the Commodity Futures Trading Commission that seeks to provide investors with up-to-date information on futures market operations and increase the transparency of these complex exchanges. So what that basically means is it's a report that's released every Friday that shows what the money managers are doing, what the big banks are doing, and what the small speculators are doing, like me and you. All right, that's basically what it is. It's released by the CFTC. Not many people know about this, so you can find this by going to cotbase.com, and basically it's for all futures. So you have all the currencies, all the energies, all the grains, livestock, metals, softs, stock indexes like the Dow. Now some of you like to trade the Dow and S&P 500, treasuries. Anyway, so here, let's start, for example, with currencies. We have the Australian dollar. Now, the commercials over here, for simplicity's sake, let's say the commercials are the banks. And the large speculators, the trend followers, are the hedge funds. And the small speculators are like me and you. All right? So what we want to do is we want to follow the commercials, and we want to be contrary to the small speculators. Okay? The commercials, they signal trend changes in the market. Large speculators are trend followers. So at the time you follow their trend, it could have ended, you know? So we always want to look as traders for the reversal points. That's how I like to trade. I like to find reversal points in the market. So I'd like to see commercials signaling a trend change while the small speculators do the opposite. That's a very ideal situation for me. So let me start with some examples. A few weeks ago on trades I took. The British pound, for example, many of you know today is the 2nd of May 2017, and the British pound is in the sky basically, right? It's been rising ever since forever. For the last 2-3 weeks, it's just been going up and up and up. Now I want to show you guys how this trade could have been caught. All right. So we have the pound here, and let's look at what the commercials are doing. Right. This is a zero line, by the way. If they're under this, this is net short. If they're above this, this is net long. And so let's see what they were doing. They were over here. They were over here. At around this point, they started to go heavy net long on the British pound. And what do we see in price? It starts to rally. Now, how could you have caught this? Let's say prices were dropping here, right? These guys were selling, right? Trend followers, okay? These guys were buying. See here? See, while this dip was going on, every Friday, they were adding more long contracts. You see here? You see? They were adding more long contracts. So they were signaling a trend change. And they kept on going up and up and up until we see this rally, right? And then now they start cooling down a bit, then they go net long once again. You know, heavy net long once again. And then we see this rise. Now how can you trade this in Forex, you may ask? Well, it's very simple. Look for something else that has heavy net short on it, for example, like the Australian dollar. This is an extreme net short for the Australian dollar. This is very extreme net short, you know. And look at what the banks were doing. on this rally. They were selling into it. They were selling into this. Okay, they were selling here, selling here. They were extreme. One second, let me go and find the exact date of when this rally happened. You know what? Let's go back to the initial rally over here. When did this happen? I'd say around the beginning of March. Sounds about right. Okay, so let's go to the Australian dollar. Let's go to the beginning of March. Right here. This is heavy net chart. Okay, so let's see the pair, the pound against the Australian dollar. Right, let's open a 4-hour and let's see. At around the beginning of March, we see mid-March we find the bottom here. Around mid-March, so mid-March is, I'd say around here. Around here. This is mid-March. If you guys swung this, you could have, like, if you guys were buyers in here, look at the move that could have been caught. That's it's a lot of pips. It's over 1,000 pips in this move. Let me guys show you. When it really took off is around mid-March, right? And it started to take off like this. It was mid-March. Look at the British pound on mid-March. This is when the British pound started to take off, right? This is when they went extreme net long. You see this? This is mid-March. This is around mid-March. And now the COT report is not good for timing the market. Okay, this is just to give you a directional bias of trend changes that are about to occur. You do not use the COT report to time the market, okay? Because these people are very big money. They can handle price to go against them a couple of hundred pips. They can handle it, okay? So you don't use this to time the markets, okay? Use whatever you use. Use your technical indicators. Use Fibonacci retracements, whatever you like. But this is just to give you an idea of a trend change about to occur, the directional bias. That's it. You don't use it to time the markets, okay? It's very important. This is just to give you an anticipation of whether you should be buyers or sellers in the next couple of weeks. So here they went net long again here after they probably took profits here, and then you see the price went down a bit, and then again they were buyers here, and they were buyers at a time where we could have still caught this move again, right? Because this was a Friday, and we see this here, right? The Australian dollar. Very heavy net short. This is a very simple trade. You see how the pair work with the COT. If your directional bias for the next couple of weeks was to buy, you could have swung this. You know, if you started to buy, even if you bought here, right, and price went against you, you could have bought again. You know, that's how it is. That's what the banks do, right? This could have easily been forecasted. Very simple. Now this is just my first example. I want to give you guys another example about oil. I'm going to show you guys. I'm going to show you guys oil. Let's see. Oil is very interesting. I want to talk to you guys how this rally in oil could have been seen. Now, oil is down today, but I'll actually give my analysis on the recent developments in my next video, not this one. I want to talk about how this rally could have been seen, because it's been forecasted. This rally right here, from 47 to 53. Now this could have been like, if you open the COT report, again you're back here on cotbase.com, you open up energies, open up crude oil, and what were they doing here? What were the commercials doing here? They were still not short, but what were they doing here? They covered their short positions. They went long, right? They started buying this dip, right? They were buying here, they were buying, then this happened. Now you could say that how can we know if that's going to happen or not, because they're net short, right? These people are hedgers, so the biggest short seller in any market will be the banks themselves, the commercials themselves. They hedge their real positions, right? So for this specific trade, you need to look at correlation. So what correlates with oil? It's the Canadian dollar. The Canadian dollar correlates with oil, right? Most of you know that. And let's see what they were doing. Let's see what the commercials were doing. They went from net short to net long in a week. They went from net short to net long in a week. Now, why would they do that? Why would they enter an oil-linked currency? Why would they heavily buy that? Why would they do that? They won't do it for no reason, right? If they're going into a currency that's linked with oil, that means they expect higher prices for oil, right? Because that's what drives up the Canadian dollar, is oil. So if they're buying the Canadian dollar, it must mean that oil will go higher, right? They know something that we don't, and we don't want to know what they know, okay? All we want is to make money from the markets. That's it, right? So when did this happen? Okay, I'd say in the end of March, around mid-March. I'd say mid-March. Mid-March is when they went bullish on the Canadian dollar. So let's have a look at oil over here. Crude oil. Around that same time, prices were still down here, and at the same time, these guys covered their short positions and just went a little bit long. At the same time, right? This rally started around the beginning of April. The beginning of April, we see this massive rally. Now, this could have been seen by looking at this COT report to confirm it, that they were actually covering their shorts and going long on crude oil and the Canadian dollar, right? Because the Canadian dollar, again, is a currency which correlates with oil. Higher oil prices means stronger Canadian dollar, right? So if they were heavy buyers of the Canadian dollar, it means they expect higher oil prices. It's all very logical. And here's exactly what happened. Oil prices rally. That's my second example. Now let me give you guys a third example. And I'll give you guys weekly forecasts. I'll be posting up videos, so don't worry about that. Now, let me open up the yen. Now this is the yen, okay? So let's have a look here. Let's have a look at what they're trying to do. What were they doing on this dip, right? The smart money buys on downward candles, right? On red candles, they're buying. They put buy orders here. They're buying all the way. They're buying, right? They bought this dip. Around here, they started buying. They were buying from here. They went to net long. They went net long here. And in a month, we see this rally, right? After they go extreme net long on the yen, we see this rally in the yen, right? And look at what the small speculators are doing. They're selling here. They're short here. You know, they're dreaming of catching anything. And now that they're buying, prices are declining. You see how this works? So what correlates to the yen is the price of gold. Am I right? So let's look at the price of gold. Let's have a look at it, okay? Doesn't that look like the yen? Right? Where do we see this start to go up? We see it and around the end of December and the beginning of January, the beginning of the new year. Now, guys, if I remember at that time, people were screaming that gold is going to 900. You know, that's it. It's the end. This is the year of the dollar, and the dollar is gonna uh, devastate everyone, and that's it. The gold's going to 900. Gold's going below 900. You know, I remember everyone was screaming that. You know, but that's not what happened at all. Now, if you were looking at the commitment of traders report and you were looking that the smart money is going into safe haven assets, because gold and the Japanese yen are safe haven assets. Now, if the smart money, the commercials, if they're buying safe haven assets this aggressively, okay, they were extreme net long here, around the beginning of 2017. They were extreme net long. Why would they do that? They don't do things for no reason, okay? We don't want to know why they do it. We just want to follow them, okay? We should have been looking for a buy signal once they started, not here, once it starts going here. Okay, this is like 2 or 3 weeks of confirmation that they're heavily buying. We should have been looking for a bottom here, especially that the small speculators are selling. We should anticipate a bottom somewhere here, around this place, right? And if they're buying the Japanese yen, that means they expect higher prices and other safe haven assets, right? Like gold. I mean, if they're buying the yen, what drives the yen up is gold. So if they're putting their money in the yen, they expect higher prices for gold to strengthen the yen so they can profit off of their buy positions. Am I right? So here's gold. It's the same thing. Starts to rally. Small dip. This is where the smart money buys. They always drive prices lower like this suddenly just to put in buy orders. You know, they put their orders in small blocks like this. You know, all they want to do is buy things. If they want prices to go up, any dips, they will be buyers in any dips. They just want to get cheaper buys. Like they wanted to buy gold while it was cheap. So they drive prices lower. What do they do here? They buy. They buy. They buy, they buy, they buy, they buy. Prices rally. That's basically what the smart money does. If they're heavy buyers, you know, and they drive and you see price dip like this, it's not going to continue down. No, they're going to put in buy orders. You get confirmation with this when you open the yen, for example. They were still heavy buyers, you know. They were still heavy buyers. Yeah, they cooled down here, but again they were heavy buyers, you know. They were still like net long compared to the last few months. They were still net long. They were buyers. So if they're still stuck in safe haven assets, it means you just buy the dips, right? You buy the dips on gold, you buy the dips on the yen. That's basically what it is, right? That's 3 examples for you right there of how to use the how to use the commitment of traders report, and it's a very powerful tool. It'll take you some time maybe to understand exactly how it works. Again, this is not for timing the market. Okay, you don't use this tool to time the markets. You use it just to have a long-term, where you anticipate a long-term trend change. That's when you use commitment of traders report. Use your technical tools, use whatever tools you use. You probably have your edge, right? You probably have something that works for you. That's great. Apply it with this, okay? And you can anticipate trend changes. And you'll be surprised. You'll be surprised. It'll blow your socks off how the market reacts to this. It's very interesting things. I'll give you guys another example. Why not? Let's see the peso. Now, some of you like to trade these currencies. Very nice example of the peso here, right here. At this dip, these guys were buying. You see, these guys buy on bad news. They buy. They're always opposite what everyone is doing, right? They are the trend changers. The commercials are the trend changers. We always want to see what they're doing. They were buying all in here. They were buying here, buying here. Prices still dipped against it. See, the price went against them, but they still bought. They bought it here, right? They bought, they bought, they bought, they bought, they bought. And then when prices start to rise, now they want the other trend change. They start selling, right? See how that works? Over here, you'd have probably found the bottom. And then this trend goes on. They close out their positions. They start selling, 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 selling. You know, they're taking profits. And then again, prices start to decline. And I think this is going to go a lot lower. You know, I think the USD Mexican peso is going to go a lot higher from where it is right now. And we'll see what happens. We'll see what happens with that trade. That's a very nice trade. We'll see what happens. If you guys sit with this and study this carefully, you'll see how this causes trend changes in the market. It's very, very interesting, and I'm sure you guys will find it very fascinating if you just spend a little bit of time understanding what I explained in this video. You'll see things in front of your eyes. This is one of my favorite one of my favorite trades, British pound. Look at that rally. That makes me happy. Tears of joy right there. Very, very, very simple things. And I learned a lot of my things from Larry Williams. He talked a lot about the commitment of traders report, and it's just terrific. There's also seasonal patterns he talks about. You can buy his book and read it. You can probably find it on Amazon. Talks about how around mid-April, there's always a rally in the British pound. So he talks a lot about that. He likes seasonal tendencies, and that's basically it. He's a very good person. Very good trader. Amazing trader. So I guess that's it for the COT report. And I'll be uploading more educational stuff. You know, this is just the tip of the iceberg. This is just a very brief overview of the commitment of traders report. There's still a lot of things that go into this, like open interest and volume, and I'll explain it more in depth. But I want you guys to understand this concept first, and the rest will follow. All right. I hope you guys enjoyed this video, and good luck and good trading, my friends.